This video is the one you need to watch. You probably need to save it too. You need this information for open enrollment or if you're picking health insurance because most people are about to make a big mistake.
There's a huge mistake that almost everyone makes, a real flaw in how we approach it. We tend to look at one number and one number only, that monthly price. But what if I told you that focusing on that one little variable is completely fundamentally the wrong way to do it? Because that low monthly premium you think is such a great deal, it could be hiding a really, really nasty surprise. It's often a carefully set financial trap, one that could end up costing you $10,000, or, let's be honest, maybe even more, right when you can least afford it. The real question is, are you about to walk straight into it? It's bait. It looks good, right? It's easy to reach for, but it's designed to distract you from the hook that's attached to it, those massive hidden costs that can pop up after a major medical event. So let's break this down. We're going to dig into exactly what this premium trap is, and more importantly, how you can spot it a mile away and just avoid it completely. So here it is, the single most important takeaway. If you are shopping for health insurance based on the monthly price, you need to stop. I mean it, right now. You are optimizing for the wrong variable, and you're putting your financial health at some serious risk. We need a better system, a better way of thinking about this. And that system? Well, it starts by understanding that your insurance plan isn't just a price tag you see online. It's a machine. It's a complex system with a bunch of moving parts that all have to work together. In fact, every single insurance plan you'll ever look at is built on 5 interconnected levers. These levers are what control what you pay, when you pay it, and just how much you're on the hook for. Understanding how to balance them, well, that's the whole key to making a smart decision. And here's the core principle of this whole system, the thing you have to get. These levers are all linked together. It's kind of like a seesaw. You can't just push one down without another one going up. So if you pull that premium lever way, way down to save money each month, you better believe the insurance company is pushing another lever, like your potential out-of-pocket costs, way, way up. It's always a balancing act. So the most crucial thing is to know what each of these levers actually does. Let's deconstruct this machine, take it apart, and look at all 5 levers, one by one. First up, the one we all know, premium. The easiest way to think about this is like it's the monthly rent for your health coverage. You pay it, doesn't matter if you use the insurance or not, just to keep the lights on and your policy active. Okay, next up is the deductible. This is what I call the entry fee. It's the amount of money you have to pay for your own medical care before your insurance company even starts to help out with the major costs. You have to clear this hurdle first. Here's a great way to picture it. Think of your benefits as being on the other side of a giant toll gate. To get onto that benefits highway where your insurance company starts paying the big bills, you have to pay the toll first, and that toll is your full deductible. Lever number 3 is the copay. Now this one's pretty simple, kind of like a convenience fee. It's that flat fee, maybe $25 or $50 that you pay for a routine doctor's visit or when you pick up a prescription. It's predictable, it's straightforward, no surprises here. And now we get to the most misunderstood and honestly the most dangerous lever of them all, coinsurance. We call it the percentage trap for a very, very good reason. This is the percentage of a medical bill that you are responsible for after you've already paid your deductible. And this is where things can go sideways fast. Most people have this massive blind spot when it comes to coinsurance. They see a small percentage, like 10 or 20%, and they think, oh, that's not so bad, I'm safe. But that percentage applies to the total bill, and that is exactly where the trap is set. Remember that balancing act we talked about? Well, this is it in action. To offer you that super attractive low monthly premium, insurance companies will often jack up the deductible and include a coinsurance clause that leaves you way more exposed. What they're doing is shifting the risk from their books onto you. So let's run the numbers on a real-world situation. Let's just imagine you need surgery, and the total bill comes to $50,000. Yeah, it's a huge number, but believe me, it is not uncommon in healthcare these days. So your plan is a 20% coinsurance. On paper, that sounds pretty reasonable, doesn't it? I mean, the insurance company is still covering 80% of the cost, but what's 20% of a very, very large number? $10,000. That's your slice of the bill. And remember, this is after you've already paid your full deductible for the year. All of a sudden, that cheap monthly premium, it's not looking like such a great deal anymore, is it? Just let that sink in for a second. That low premium you were so focused on feels anything but cheap when you're staring down a $10,000 bill. This, right here, is the premium trap in its rawest form. So, if the premium is the wrong variable to be optimizing for, what's the right one? Well, the answer is in defining your true financial safety net. It's about knowing, with absolute certainty, what your worst-case scenario actually is. And that brings us to the fifth, and I'm telling you, the single most important lever of them all, the out-of-pocket maximum. This number is your finish line. It is the absolute hard stop, the ceiling on what you will have to pay for your medical care in 1 year. Once you hit this number, the insurance company pays 100% of everything else. This number is your real protection. So let's just redefine the whole objective right now. Your goal is not to find the lowest premium. Your goal is to find the plan with the lowest total financial exposure that you can still comfortably afford. The number you should be obsessed with, the one that truly, truly matters, is your out-of-pocket maximum. And that really just leaves us with one final question for you to think about. When you sit down to choose your next insurance plan, what are you really optimizing for?